So finally we're going to look at the variance at risk calculation. So I'm just going to start here at the variance covariance matrix. We are going by a model building approach, and we are going to build a minimum variance portfolio. We've actually decided to look at this from a short selling and no short selling perspective, just to add a little bit to the question. So we've taken our variance covariance matrix. I've put my stock names along the top and along the side, so it's pretty easy to read. So we can see here AVB has a variance of 18.588 and it has a covariance with VA of 1.828. So if we move on to the next part, then we are going to calculate our MVP. So essentially what we need for this is an identity matrix, which is a 1 by 10, so it's going to be the number of stocks and an identity, so everything's 1, multiplied by our V inverse, so our variance covariance matrix inverse. And when we get that, we want to look for our denominator, so we take the numerator inverse multiplied by the identity matrix. And the next step then, so this is giving us a MVP portfolio with no short selling. So to take our assets and find out how much we're going to be investing into each one, we divide by this denominator, and we find that CTL is going to end up being a short sold asset. So it's not going to be very much, it's less than 1% of our portfolio, but it will be short sold under this framework. So what we do then to look at our MVP with no short selling, we sum our weights to just double check, okay, yeah, we've got 100% of our investment invested across the board, and our expected return for this MVP is going to be 0.09. So then we move down, and what we do exactly is we take these figures, we compute a solver to maximize these values so that they're greater than 0, not maximize, but make them greater than 0, and have them sum to 1. And by doing that, we drop out our CTL because it was a short sold asset before, so we're probably expecting CTL returns to be negative, so that you don't really make money of them by short selling. And we find that we're probably going to invest about 38% into VA and about 11% into ABC. So then what we can do then to calculate our value at risk, we take our mean returns, our variance covariance, and our portfolio proportions. So in this case, it's our short selling. We just end up working out our variance at risk calculation, and we do this at the 1% level for 1 day, and then to find the 10-day level, we multiply that by 10 to the power of a half. That's as per whole. And what we find is, so for a £1 million investment, our variance at risk level is going to be 18 million. So over the 10 period day, the maximum that we can lose at the 1% level is 18.5 million, which seems quite a lot. 18 times our investment. And then if we look at it with no short selling, for the same investment, the variance at risk for the 10-day is going to be 14.5 million. So it's a slightly less risky position to take, and that's probably due to the fact that when you short sell, like, your upward losses are pretty high. So that's just the conclusion of that part there.